Okay, hi everyone, welcome to today's webinar. For today's session, we are going to be talking about the top candlestick breakout patterns. So let's just go ahead and get started. Okay, firstly, before we get started, as per usual, a risk warning and disclaimer. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and the risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We'll start off by doing a brief recap on what are candlesticks, reversals versus breakouts, and then we'll talk a bit about our top candlestick patterns. We'll do a brief recap of last week's topic, which was the top 3 reversal patterns, and then we'll look at this week's top 3 breakout patterns. So if you have any questions, feel free to pop them into the chat or in the Q&A section, and I'll try my best to answer them. Okay, let's go ahead and get started. So to start off, let's look at the anatomy of a candlestick. Excuse me. Firstly, we have the bullish candle, where your high price and your close price is the upper candlestick wick. The body of the candlestick starts from the close price to the open price, which would be the bottom of the body of the candlestick, and then your lower wick comprises just of the low price. Bearish candlestick would just be the opposite, so your high price and your open price would be the same, and your close price would just be at the bottom instead of at the top for a bearish candlestick. And your low price and close price are the same. Okay, so let's talk a bit about price action trading approach. So this basically comprises of 2 different trading approaches, the reversal and the breakout. So let's firstly talk about the reversal. So we talked about reversal last week already. In case you've missed out on that, feel free to, I think we might have recordings since this session is being recorded. So feel free to email IronFX email. I think the email should be on their website. Feel free to ask them for the recording, and I'm sure they'll help you out. So firstly, we have the reversal. Here we have price moving within an ascending trend channel. Here we have a morning star formation. We'll go through a little bit in detail about this formation. But basically, this is a reversal formation, and you can see it's also kind of testing that bottom part of the ascending trend channel. So we're expecting prices to bounce off of that channel and hit towards the upper part of the ascending trend channel. Okay, you can see that's exactly what happened here. In fact, it even pushed above this resistance level from where the swing high is at, pushed above it, and is still continuing within that ascending trend channel. On the other hand, we have the breakout. So here we have the resistance area that price is trying to break through. Okay, so we have this resistance level, which is in line with a couple of swing highs, a couple of swing lows, and that basically makes it an overlap resistance. So an overlap resistance basically happens when there are swing highs and swing lows that respect that area. And these are important because it shows that the bulls and bears of your price basically, any securities price basically respect that level. Okay, and here we actually see this formation again with price breaking out of that huge resistance area. So that is the breakout that we're referring to here. The formation that we see here are the three white soldiers. I'm expecting prices to continue to move upwards since there is a breakout already and there is also this formation here. You can see that's exactly what happened here as well. Okay, now let's quickly get into the different candlestick patterns. So we did go through a couple of them already. And if you weren't here for, okay, we just have a couple people who just joined. Yeah, so we did go through a couple of these patterns in our previous price action series. But I was just gonna do a recap in case you weren't here for that. So let's firstly look at the top three single candlestick patterns. To start off, we're gonna look at the hammer and hanging man. These are pretty straightforward. Basically, if we're looking at a reversal from price moving in a downtrend to an uptrend, we're looking at a hammer where the upper wick of the candlestick is much lower than the bottom wick of the candlestick. Hanging man, of course, would be the opposite, and it would be a reversal from an ascending an uptrend into a downtrend. Okay, next we have the inverted hammer and the shooting star. So the inverted hammer basically doesn't have any bottom wicks at all, and the shooting star as well. So you can see it's exactly the same. Difference would just be the color of the candlestick. Inverted hammer, since it's green, it's obviously a reversal into an uptrend. Shooting star is obviously a reversal into a downtrend. Okay, now we're gonna look at the doji candlestick patterns. Excuse me. So your dragonfly doji is basically this letter T shape. And your greystone doji is basically this upside down T shape. Again, these are reversal patterns. So when you see price moving in a downtrend, followed by a formation of a doji candlestick, we can expect prices to then move in an uptrend. Your gravestone doji would just be the opposite, with price moving in an uptrend and then into a downtrend. Okay, now let's look at the top two double candlestick patterns. So we basically have the bullish and bearish engulfing first. Again, pretty straightforward. We just have a shorter candlestick starting from the end of the second candlestick, or rather, your second candlestick starting from the bottom of the first candlestick. And then price is significantly longer compared to the first one. And that's the exact same for bearish engulfing, just that the colors have switched. Since obviously here we're looking at a reversal from a downtrend to an uptrend and an uptrend to a downtrend, as signaled by the name bullish and bearish. Okay, that's pretty straightforward, I think. So let's move on. Next, we have the tweezer bottoms and tweezer tops. Again, your tweezer bottoms are reversal patterns from a downtrend into an uptrend. So you can tell that the color of your candlesticks are basically, it's pretty straightforward. So your color of the candlesticks will tell you exactly the direction of price. So here we see prices moving in a downtrend. Your first candlestick is red, the exact same candlestick shape with no upper wick. Is moving in an uptrend with price in a green color candlestick. Next, your tweezer tops would just be the upside down of your tweezer bottoms, with price moving in an uptrend at first, as signaled by this green candlestick, and then price then reversing and moving in a downtrend following this red candlestick here. Okay. Okay. Let me know again if there are any other questions. If not, let's move on to the top three triple candlestick patterns. Okay, firstly, we have the morning star and the evening star. So your morning star is basically a bullish reversal. Price is moving in downtrend. We see this longer candlestick followed by a really small candlestick, and then a longer candlestick again that starts pretty much when the second candlestick ends. Okay, you can see the wick here aligns nicely with the body of our second candlestick. Okay, and for our evening star, we see this bullish candle, followed by that same small candle, and then followed by a similar sized second candle, both of which are bearish. Okay. Next, we have the three black crows and the three white soldiers that we saw earlier. These are pretty straightforward. Your three black crows basically signify that there is a confirmation of a downtrend with prices three pretty similar candlestick formations, one after the other, moving in a bearish manner. Three white soldiers would just be the opposite of that. So you would just have three of the same bullish candlestick patterns, one after the other, pretty similar in shape as well. And yeah, basically confirms the strength of the established trend. So for black crows, obviously it's a downtrend. White soldiers will obviously be an uptrend. Okay, so these are more so not so much reversal patterns that we've been talking about for the past few candlestick patterns. These are more so continuation patterns. Okay. Okay, so next we have the three inside up and the three inside down. Again, this is quite difficult to find, I think, because you have a first candlestick. I think this formation is quite popular, um, and quite difficult to spot. But anyway, we have a first candlestick that's bearish for our three inside up, and your second candlestick would start approximately around the same area as the first candlestick that we see here. But it should be shorter. It doesn't have to be exactly like this. Just has to be shorter than the first. And then your last candlestick should start approximately when the body of the candlestick starts as well, the second candlestick. Okay. With three inside down, you can see price is once again giving us this bullish candlestick first, since it is a reversal pattern. So it's a bullish candlestick, and then price starts around the same area once again. It's a shorter candlestick, followed by a really long one, that starts again where your second candlestick will end. Okay, so these two are also reversal patterns. Okay, so now let's look at the top three reversal patterns. We talked about these briefly last session as well, so I just wanted to do a brief recap. So we first have the head and shoulders. Okay, we have firstly this trend line with that lines up with our swing low here, second swing low, and third swing low. That pretty much categorizes this pattern. And then from the head, price will break out of that ascending trend line and proceed to test that trend line again with the right shoulder, break below this neckline, um, Yeah, and we are expecting price once it breaks out of this neckline to then go in for a sell towards this target here. Okay, so that's the head and shoulders top. Here's the head and shoulders bottom, which are just the opposite of what we were talking about with the top. So here instead of an ascending trend line, we have a descending trend line. The head is, I guess in this case, it's not really a hit since it's a swing low. Um, but yeah, so the hit here, and then once price breaks out of that trend line and retests that trend line from the top, it's then formed a right shoulder. Once it breaks out of that neckline, we then go in for a buy towards that target. Okay, okay. Next let's look at the double top. These are pretty common as well. Okay, do you want me to go back to this one? Okay. Yes. Okay. Um, so the one that we were talking about are the head and shoulders bottom, which is basically the bullish version of your head and shoulders top. Again, prices are moving in a descending trend line at first. Once it breaks out of it, that's where your neckline is formed. Retest that trend line, forms your right shoulder. Once it breaks out of that neckline, then we go in for a buy towards this target level here. So your target level would be typically anywhere below this neckline, or in this case, above the neckline. Um, yeah, it can be anywhere from here, can be this swing low as well, but obviously if your target, um, your risk reward ratio is greater, you will want your target to be a little bit further away if you are certain that price is going to continue upwards to reach your target. Okay, so that would be the opposite of this, the top, which you are going in for a sell towards that target. But again, the concept is the same. You're going in only when price breaks out of this neckline, going in for a sell towards a target that's way below this swing low as well. Okay, it could even go below your former um your original price. Just make sure that you're certain that price is actually gonna reach your target. Okay, next let's quickly look at your double top. So for your double top, these excuse me, basically is a reversal pattern again, formed by two consecutive highs that we see here. We have a swing high one, swing high two, and they're kind of about the same level. So if there's a slight difference, that's okay. But they should be about the same level. And an intermediate low, which would be here, as you can see. So it's expected that after the price again reaches the level of the first high, like we see here, um and then it reverses and falls below the level of the intermediate low, then we can expect that the fall will continue further by about the difference between the highs and the lows. Difference between the highs and the lows basically means the peaks here and this low here. That's why you can see our target is way below here, kind of about the same distance as the difference between the peaks and this swing low here. Okay, so this pattern is considered formed when after the appearance of the second peak, which is here, the price or the close falls below this neckline. So again, your neckline will be over here. And the dotted horizontal line, which you see here, ends with the target label, and it indicates the expected price level after the pattern has been formed. So as new bars appear, the line extends to the right until the last bar, until the pattern status changes from waiting to another, which basically means that here we are waiting for price to reach our target, but you can expect price to continue moving to the right here. So once it reaches your target, then we'll be waiting for another of one of these patterns. Okay, any questions? All good. Okay, next let's look at the opposite of that, which would just be a double bottom. So it's pretty similar. Again, we have, instead of swing highs, here we have swing lows with, again, they should be kind of approximately the same, the same height. Okay, so they should kind of be about the same height, between these two levels and between your swing low here. So this is what we call our intermediate low. So your target, again, would be about the same distance here. If you count the boxes, right, from the neckline to your target, you can see it's 1, 2, 3, 4, 5. Your height of the bottoms here, 1, 2, 3, 4, 5. So it's kind of about the same distance. Okay, that's where you should place your target profit. Okay, do you guys have any questions? So basically, how you find this formation, we're just going through how to spot the formations and where you should place your target, or your take profit levels after you've been able to spot them. That's basically all this webinar is. Okay. Okay, let's move on to our next candlestick pattern. So next we have our triple top. So okay, so your triple top pattern basically shows that price has tested this resistance level since we have three swing highs testing this level, but price has been unable to penetrate this area, where the peaks are at. So if we are talking about in a real life context, it basically means that after multiple attempts, the asset or your security or your currency, whatever it is that you are trading, is unable to find that many buyers in that same area or in that price range. So as the price falls, which we see here, recent pullback low and the trend line, when it falls, it then puts pressure on all the traders who bought during this pattern to then start selling. So if the price can't rise above that resistance, then there is limited profit potential in holding onto it, obviously. So as the price falls below the swing lows here, as it falls below it, selling might escalate as former buyers exit losing long positions and new traders excuse me, and new traders jump into short positions like we see here. Okay, so that's kind of the psychology behind the pattern that we have here. Okay, so there are times when a triple top, like we see here, when it'll form and then it'll complete. So then traders might believe that the asset will continue to fall after it breaks below this pullback. But the price might then recover and then move back to that resistance area. Okay, so for protection, a trader could place a stop loss on short positions above the latest peak. or above a recent swing high within the pattern. So one of the swing highs here, for example, could work. And then this move basically limits the risk of the trade if the price doesn't drop and instead rallies. So here we see a very significant drop after the swing, after your triple top, but that might not happen. So that's why we place our stop loss on short positions above that latest peak, which would be somewhere here or maybe here as well. Okay, so I guess same thing with a triple bottom. It's pretty much the same concept. We have our triple bottoms here. Price breaks out of that neckline. And then we go in for our take profit over here because it's a confirmation that price is going to continue to rise. Similarly, like over here, once it pushes below this swing low, then it's confirmation that price is going to drop. So that's why here it's the opposite. So that's why we're going for a buy towards our take profit here. Remember, your take profit should always be kind of after that neckline. So it could be somewhere at this previous swing high. Just as long as it's past that neckline, it's fine. So one of the drawbacks of these triple patterns, and that's pretty similar to your double tops and bottoms as well, that we talked about previously, is that the risk and reward ratio is a drawback on these patterns. So since both the stop loss and the target are based on the height of your pattern, so your height is basically here. Height is basically the height of your swing. Here would be swing lows. Previously would then be your swing highs. So the height of your pattern, you can see they are roughly equal. So patterns in which your potential profit is greater than the risk would of course be most preferred since your risk to reward ratio would be greater. So instead of doing that, you can place the stop loss within the pattern. So within this pattern, instead of above it, or I guess in this case would be below it, and this would improve the reward relative to the risk. Okay, of course, this also depends on where your entry points are, where you get in once this formation has been formed. But yeah, normally your risk would be somewhere after this triple bottom, and your take profit, as long as it's beyond this neckline, you should be fine. Okay, any questions so far on our reversals? There are a lot of sources out there. If you just search up chart patterns or candlestick patterns, a lot of websites will go through this pretty in-depth as well. So if you're still confused after this, feel free to just check that out or look at the recording of this webinar, which again, I think if you email IronFX, they'll be happy to help you out. Okay, let's look at our top 3 breakout chart patterns. Firstly, we'll be looking at our falling wedge, then our bullish rectangle, and then our bullish pennant. Okay, so starting off with our falling wedge, this is where we would roughly place your take profit entry and stop loss levels. I guess these are also kind of your triangles, or I think, yeah, it would be your triangles as well. So in this case, a falling wedge would just be a descending triangle. So the upper line, which we see here, basically matches or it connects the lower highs to the bottom line. When I say lower highs, I mean because there is a swing high here, here, and here, but price is making the swing highs are lower each time. That's basically what I mean by lower highs. Okay. So an ascending triangle, which we see here, or an ascending wedge, you can see it's moving, it's kind of just the opposite of this, with price making higher lows. And then we have the upper level, which is kind of just following price. So it is still moving upwards, but not at the same level as our bottom line. Okay, so for your ascending triangle here, the upper line will go through most of the equal highs, so it doesn't have to go through all. And your lower line just has to connect all of the lows. So it's just the opposite of this shape here. Take profit would be above that higher swing high rather. Your entry would be somewhere in the middle here, and your stop loss just has to be below this lower line. So it would be the same thing, just opposite for your ascending triangle. Stop loss would be on the top, entry would be somewhere here in between. Past this should be maybe here, okay, and then your take profit just above it over here. Okay. So normally with an ascending triangle, traders will buy when the price breaks above that upper line. And in a descending formation or a falling wedge, like we see here, they wait for price to fall below that lower line here. Okay. Yeah, stop loss, take profit. We've already gone through that. Okay, let's move on. So next we have a bullish rectangle. So these, I think another name for this is the flags. So for flags, I think it signals a trend continuation. So here on our screenshot from TradingView, we have in ascending rectangle. Okay, here we have kind of a symmetrical, again, it's bullish as well since price is moving in an uptrend. And flags consist of the flag itself and the flagpole. Flagpole is just this line here. So of course, if it's a bearish flag, would just be the opposite. It'd just be coming down in a downtrend. So they are normally framed with two trend lines, where in a bullish flag, like we see here, they will connect the lower highs, okay, which is here, the lower highs and the lower lows. And in a bearish flag, it'll just connect the higher highs and the higher lows, since it'll be the opposite of this. So to spot the pattern in a price chart, you kind of just have to wait for a strong price movement, followed by a move in the opposite direction, like we see here. Okay, so these kind of rectangle or flag shapes signal a trend continuation. So in this case, since it's a bullish rectangle, we would then continue to buy in a bullish trend um, when the price rises above the flag's upper boundary. Upper boundary basically means this line here. Once it raises above the triple swing highs here. Or if we're looking at the price chart, as long as it raises above this swing high. Okay, so for your stop loss, we would normally recommend you to place it below the lower band of your formation. Your entry, as we mentioned earlier, would just be as long as it breaks above that upper line, and your take profit would just be anywhere above it. Okay. Okay, next let's talk about the bullish pennant. So pennants it basically combines the features of a symmetrical triangle that we talked about earlier, or the wedge that we talked about earlier, with the features of the flag pattern. So you can see it has the shape of a symmetrical triangle, but the profit targets, which you can see this kind of flag formation based on the length of like the flagpole or the uptrend. Okay, so the pennant again is a continuation pattern. So that appears during a short-term consolidation within a strong trend. So if you're able to identify it in a bullish trend, like we see here, it's most likely to break above its upper boundary here and continue rising. So if you see it as a bearish pennant, of course, it would be we're going to expect it to break out of the bottom boundary and continue to fall. Okay, so on spotting a pennant in a downtrend, which we don't have here, traders usually will sell on a breakout of a lower line. Here we see bullish pennants, so they will usually buy as soon as the price breaks above this line here. Okay, we would normally place your stop loss just below that lower boundary again, so similar to the flag. Entry would be as long as it breaks out of the upper boundary, and your take profit would just be anywhere above um those levels. Okay, but it is kind of supposed to be an equal length that's recommended. So equal length between the beginning of the movement, so it can be the flagpole here, as well as the movement from here to your take profit, or whenever price breaks out of that upper boundary. Yeah, you're right. They are really similar. It's just this bullish pattern is just a combination of the triangle as well as your flag. So the main difference between it is just this flagpole thing that we have here, which basically tells you the uptrend and the downtrend. So this is kind of a confirmation, I guess, of an uptrend happening. Whereas if we go back and look at our wedge, right? I mean, I guess here we also have that flagpole in this animation. But if you actually look at the price, we don't really um have that flagpole. It just straight away starts as the bottom line and your upper line. Okay, but yeah, they are pretty similar. There aren't that many rules when it comes to this. I guess I wouldn't call it rules, it's just more of being able to spot these formations. So if you just Google, I think like um I guess this would be breakout patterns. So if you just Google um breakout patterns, these should come up. And there are a lot, so don't worry if you don't get it straight away or if you're not able to remember all of them. We're only going through the top to use for now. There are others on the market as well, so feel free to just check those out. Okay, so now let's look at combining candlestick patterns with what we already know. Okay, so we're gonna start off with support and resistance since this is basically the foundation of everything. So I did briefly talk about your overlap resistance levels earlier. But basically what we want to talk about is being able to spot significant swing highs and lows. So for example, here we have an insignificant swing. So these are bad points to use for Fibonacci. Not just Fibonacci, but any kind of analysis as well. So this is the kind of shape that we want to be looking for, with significant moves up and down. Okay, here's another example. So I've drawn out exactly how clear your peaks and troughs should be. Again, you want to make sure that your levels kind of line up with at least 2 swing highs or swing lows so that it's more significant. You can, I guess, because these levels, you can see that price has already tested these levels in the past multiple times, so these are more significant levels to use. Okay, and this applies for both your entry and your take profit levels as well. Okay, so now let's look at combining what we know. So your pullback and overlap levels, like this. Okay, so in this first example, we have a big swing high resistance level. Price surpasses this big swing high level and becomes a pullback support where we expect price to pull back or retrace back to that level. So in the green areas, we see price retrace this level and bounce off of it perfectly. And once price bounces off the pullback support, it then becomes an overlap support. Okay, another example here. So with 2 swing highs lining up, we have a swing high resistance. Price has surpassed this level and has become a pullback support. So we can expect price to retrace back to this level, and take note of the blue circles here since price bounces off this level twice, making it a really strong overlap support. Okay, and our last example here, there are multiple swing lows that are in line with that 33420 support level. Once price breaks this level, it then becomes a pullback resistance. And we can see price has tested this level 3 times over here, making it a strong overlap resistance level. Once price actually breaks out of it at point number 4, we can see it becoming a pullback support. And then once it bounces off again, it becomes an overlap support. So all of these levels combined with your ability to spot candlestick formations, and also with your trend lines, trend channels, and indicators will help you to form, as well as Fibonacci. Those will help you to form confluence and help with your analysis. Okay, so just to recap, a valid trend line is when there are at least 3 touches on it. Like here we see at least 3. Here you can combine all of this with your channels as well, like we did earlier. And yes, so just to recap again, for channels, valid channels, you want to make sure that it touches at least twice on top and twice below. Here we have more than twice. Here we have more than twice, but as long as it touches at least twice, that's good enough. And of course, next is combining these with resistance and Ichimoku as well. Okay, that's all for my webinar today. Thank you guys so much for joining me. I hope you guys found this session helpful. And yeah, thank you guys so much. If you guys like me, feel free to connect with me on LinkedIn. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye.